Stock market trends don't typically change without some sort of a fight. And we are about to enter a battle here. Inflation data is going to be coming out tomorrow, and that's a big macro report. So we need to prepare for that on today's Stock Market Brief Show, where we navigate the financial markets through the lens of technical and intermarket analysis. Now, why is this data so important? Well, it's because it's what the Fed is focusing in on. We're trying to get inflation down to 2% currently. The previous report was at 3.9. That's the year over year number. Goldman Sachs has some ideas of where the SPX may trade when we're looking at core inflation rate month over month. So we will tag into that. But I wanted to point out today the expected moves going into tomorrow's trading session. These are the daily expected moves, meaning the SPX is looking roughly at a $47 expected move. That is plus and or minus is what the market's pricing in as far as risk. And if you think of that in terms of a standard distribution curve, remember the market is saying, yeah, there's probably 68% probability that we close within below this upper level to above this lower level. But I always include the 2 sigma levels just in case. And I put that there on the swing trading community, which is $9 a month. That's one of the many benefits there. If you want to take a look at that, there is a link in the description. Now, Goldman Sachs came out and said for core month over month, their estimate is 0.32%. That's right around consensus is 0.3 for inflation rates, core inflation rate month over month. And then they have some ideas of the SPX reaction if it is greater than or if it's less than that specific number. So if we pull up this chart right here, this is the SPX on the 15-minute time frame. I drew out some of those levels for you. I'm not going to dig too deep into these specific levels. However, I will note that some of them, the minus 7.5, so if it comes in at 0.36 to 0.4, and then above us, at the 0.9% is pretty in line. Those both, and that's at the point right here, this one, which is above their, below their estimates. And if it does come within one of those levels, it's pretty close to the daily expected move, which is a large expected move for the overall market, right? Typically, we don't look at expected moves this big on a daily basis. So the market's basically saying here, prepare for battle. There's going to be volatility, and it's pricing that in. Now, if we look at the S&P 500 or the SPY on the 15-minute time frame, we are pretty much at that 5-day moving average. We're currently below it, and it's flattening out. So this equals bearish, but with caution, right? We're just going sideways. The more we go sideways, the more this will level out. But if we go down below it, this could potentially start changing trend. Now, as for today's trading day, we actually came right into the lower daily expected move, and we found some support from that level, getting back above the week to day anchored VWAP and trading just below the March anchored VWAP. So price action is tightening up here. A lot of people will call this a bear flag. It makes sense, but we're heading into a binary event where we can literally open up at one of these levels. That those right there are those daily expected moves. And if we do get some sort of a surprise, don't be shocked if we come into the weekly expected move, which was a very large expected move for the week. So much so, it pretty shocked me during a live stream today. I was looking at it, I was like, wait a second, it didn't quite make sense, but we're pricing in an $8.62, right? 8.62 expected move. That's plus or minus in the SPY for the week. And let me tell you something, you got to go back pretty far to see expected moves that large. Pretty insane stuff. Now, if we look at the gamma levels going into tomorrow's trading session, 5,200 still is the call wall. So that is where a lot of the concentration is. Remember, at the end of this week, we have a big option expiration, one of the biggest option expirations. And then we're also in the middle of a contract roll. So if you're trading ESH24, you will be trading or watching and looking at the ESM24, the June contracts. Now we are right there at that gamma flip line. We were below it today. And when we get below it, it's when dealers sell into selling, buy into buying. And we're seeing those kind of explosive moves back and forth. I do plan on going live. So if you look at the pinned comment, I have my Twitch link there. I'm going to go live on Twitch. So make sure to follow me to get notified about that. Now, I wanted to also call out the CTA positioning. Think of CTAs as just basically algorithms. It stands for Commodity Trading Advisors, but this is for the SPX. And you can see we're in a very high percentile, coming off slightly over here of almost max long right here, okay? So what happens here if you get some downside convexity and it starts projecting downwards, that's when momentum sellers sell into selling. It can get quite extravagant. However, there are key levels or CTA triggers, you can call them. And when you look at a chart like this, it's probably more towards down beneath these levels over here, maybe even further down. But what I'm going to be paying attention to is if we stay below the 5-day moving average and that gamma flip line, that means the battle between the bears and bulls may be changing, or the bear might be winning in the slight term and then, ends up being a consolidation But we just need to be prepared for those moments. If you look at the weekly candle, there was a clear fight over here between the bears and bulls. How do we know that? Well, because it's an indecision candle, very small body. It closed slightly down on the week where it basically opened, and you can see the bulls fought, right? But the bears fought, and then the bulls fought, right? So there was a big battle right here. And sometimes when you have a strong move up and an indecision candle like this, these can mark turning points in the market, these doji type candles. But you'd have to get below 50-50 or get below that weekly 5 EMA or cross above the high and close above there to negate that potential turning candle. Because if we even came up here and then later down the road we crossed back down but never broke this high, that would be looked at as a turning point in the market. Now, if we look at the daily time frame for the SPY, you can see that I drew out this little channel here connecting this low to this low and this low, and I moved it higher. And you can see actually in the middle of the trend, it actually has been acting and respecting that middle line there too as well. And you can see we're actually right there. And this is a very steep incline, and these typically break at some point to go through larger periods of consolidation. Another note here was when we were ramping up higher and higher into July of the prior year, the RSI was diverging. So we were getting lower highs in the RSI while price action was moving higher. And that led to over here, we're in about a 10% correction. And from the October bottom when we started rallying, I just wanted to call out that we do still have a negative divergence that is building currently in the RSI as price continues higher. So that doesn't mean that the door's not open to move higher. That's always a possibility. But just a couple levels to watch for is if we start breaking down that NVIDIA gap, can potentially act as a level of support. The NVIDIA gap is when NVIDIA reported earnings and everything moved up with it. And then below that is the previous all-time high from way back when over there that can potentially act as a level of support there too as well. Why? Well, because we broke out of it and we never actually came back to test it. And sometimes you get back tests and then you look for strength after the back test. So that would be a key level. An interesting signal chart that I haven't shown in a while is the NYSE-McClellan oscillator. This is the traditional calculation. And as the NYSE, the New York Stock Exchange, is kind of wedging higher and higher and getting tighter and tighter, you can see that the internals have been diverging quite a bit, right? We have a high, a lower high, a lower high, a lower high, a lower high, but we keep on pressing higher and higher. And I'm curious to know if this is going to play out potentially to the downside. We did have a divergence right here, and that played out to this consolidation. And we still have a little divergence right here. Is it going to play out? Well, history suggests that these are important to watch, but they are more valid when you're above the 150 creating divergences. So this was the last one, and we did go through a period of consolidation. So I'm going to continue to watch it, but I wanted to put that on the radar. If we take a look at the Qs on the 15-minute time frame, this one also looks like a bear flag, and we're below a 5-day moving average that is starting to decline. Okay, so the longer we stay down here, it can act as potential resistance, and it could potentially change the trend. So if we do start sinking off, continue to watch for potential gap fill here in the Qs. IWM is also getting below their 5-day moving average. So IWM, the Qs, the SPY, we're all below the 5-day moving average. Most of them are just kind of neutral to starting to decline. So if we recoup them, okay, cool, bulls are back in charge. It can potentially start turning back up and the party continues and Pepe takes that lead, okay? But if the bears hold strong here, we'll see price action put in a series of lower highs and lower lows, and that would continue until further notice, obviously until that changes. A couple other assets that we want to continue to watch would be something like the 10-year yield and the dollar. So the dollar has taken a pretty big fall from grace in the last few trading days, but we're seeing it recover a little bit with a long hanging man type candle. So it's going to be interesting when this report comes. Is the dollar going to recover and bounce? And if so, is that going to put pressure on the markets? So far, this big fall here has really helped propel the move in gold, maybe even potentially help propel the move in Bitcoin, as that has been breaking out to all-time highs as well. But then also to note the 10-year yield. This is going to be an important one to watch too. This one having a little fall from grace. Is it going to continue to break down and TLT is going to break out? Or because of this big fall here, are we going to snap back a little bit and have the dollar recoup some and the 10-year yield, which could put pressure on the markets? It's a very binary event going into tomorrow, but we have some key levels mapped out for risk and some intermarket assets to continue to pay attention. I want to close off at looking at this specific chart. This is consumer staples relative to the SPY. That's that line here. And there's been periods throughout time dating back to 2007 where you do get these positive divergences and negative divergences in the RSI and also in the rate of change. And the ones that I'm pointing out was, for example, in 2007 going into 2008, there's a there's a higher low in the rate of change here. And then there was also, not quite on the RSI, but you can see that when we did have the positive rate of change, it did play out to a potential big spike. Now, consumer staples went down, but relative to the SPY, it outperformed, meaning that they went down less. But then zoom more closely into 2020, 2022, and 2023. In 2021, going into 2022, this was a little bit of a red flag for me too as well, where the rate of change was putting in higher lows here. The price action of this relative strength line was putting in lower lows, and then the RSI matched with that too, as well as putting in a higher low. And if you look back through history, there hasn't been too many times where the RSI gets, really this, oversold into an oversold condition, dating back obviously till 2007. Well, the price action started to play out to the upside. Yes, a lot of these names did get hit, but from a relative standpoint, these gave us insight to a potential turning point in the market. So we saw a spike there, We had a negative divergence on the ROC, the rate of change, and in 2022 over here, and that was going into middle to the end of end of the year, roughly around the middle to the end, so October to December, or June-ish, right, to December. And you can see the price action fell dramatically as we had big price action moves in the S&P 500 and Qs and so forth, and consumer staples did not play. The reason why I'm pointing this out now is because we're into 2024, a few months in. We're seeing a positive divergence in the rate of change here, and we're seeing a positive divergence in the RSI. And today I saw some pretty interesting price action amongst some of the consumer staple names like HSY, right? Breaking out of a potential base, a multi-month base. MKC, I think it is, which is McCormick. McCormick is like the seasonings. That was interesting how it's building a series of higher lows into a pivot line. SYY is another one that I'm interested in that's consolidating after a big earnings move. And there's just been some various names there that look to finding strength. So I'm wondering if people are starting to rotate into these dividend type paying names for potential safety, or is it just kind of a temporary move before the market resolves itself and Pepe overall wins this battle? That's all I got for you on today's episode, everybody. Be careful and be safe out there. Look for me to go live tomorrow morning. That's all. See ya.